Let's talk about the S&P 500. Maybe you've heard of it in the news, or someone at a party casually dropped it like they were Warren Buffett. What actually is the S&P 500? Why do people care so much about it? The S&P stand for Standard & Poor's. It's the company that created this index. The 500, that's the number of companies it tracks. The 500 largest publicly traded U.S. companies. Think Apple, Microsoft, Amazon, Google, Coca-Cola, basically the big dogs. When people talk about the stock market, they're often talking about the S&P 500. It's like the pulse of the U.S. economy. If these 500 companies are doing well, the economy is likely humming along. So, how does it work? Imagine buying a tiny slice of every company on the list. That's what investing in the S&P 500 is like. You don't pick winners and losers, you own them all, and over time you ride the overall growth. Historically, the S&P 500 has returned about 10% per year on average. It doesn't go up every year. There are ups and downs, sure, but long-term, it's been one of the most reliable ways to grow money. That's why many investors love it. How do you invest in the S&P 500? It's simple. Index funds, ETFs, bundles that own a piece of all 500 companies. The Vanguard S&P 500 ETF is a well-known example you can buy like a stock. Picking individual stocks is hard. Even the pros get it wrong sometimes. Investing in the S&P 500 is a bet on the whole U.S. economy. You're saying these 500 companies will keep growing over the next 10 years, 20 years, 30 years. Most professional investors struggle to beat the S&P 500 over the long term. So sometimes simple really is better. Next time you hear about the S&P 500, you'll know why it matters. Maybe you'll impress some friends at a get-together. Investing is a marathon, not a sprint. Stay curious, stay patient, and let those 500 companies work for you. See you next time.